Hey everyone, and welcome back. Today, we're going to tackle a huge myth, one that stops so many people from building wealth. The idea that you need to be rich to start investing. Let's get one thing straight right now. That is absolutely not true. Forget everything you've heard about needing thousands of dollars. The truth is, you can start your investment journey with just a few dollars, the kind you might find in your couch cushions or spend on a daily coffee. In this guide, we're going to break down exactly how to start investing with little money, step by step, in a way that anyone can understand. So, if you've ever felt like investing was a club you weren't invited to, this video is for you. Let's smash that myth together. First, let's talk about why you should even care about investing. Simply put, investing is how you make your money work for you. When you save money in a regular bank account, it just sits there. Over time, inflation, which is the rising cost of everything, actually makes your saved money worth less. Investing, on the other hand, gives your money the potential to grow faster than inflation. It's like planting a tiny seed. With time, water, and sunlight, that seed can grow into a massive tree. Your small investments are those seeds. The goal is to grow your money over time, paving the way for financial freedom, whether that means retiring comfortably, buying a house, or simply having a safety net for the future. It's not about getting rich overnight. It's about building a more secure financial future, one small step at a time. Before you invest a single dollar, there are two crucial steps you need to take. First, create a budget. You need to know where your money is going each month. Track your income and your expenses. This will show you exactly how much you can realistically set aside for investing, even if it's just $5 or $10 a week. There are tons of free apps that can help you with this. The second step is to build a small emergency fund. This is money set aside for unexpected expenses, like a car repair or a medical bill. Aim for at least a few $100s to start, and keep it in a separate, easy-to-access savings account. This fund is your safety net. It ensures that if life throws you a curveball, you won't have to sell your investments at the wrong time. Once you have a budget and an emergency fund, you're ready for the exciting part. So, where do you actually put your money? For beginners with a small amount to invest, there are a few fantastic, low-cost options. Let's start with micro-investing apps. These apps are designed specifically for you. They let you invest with as little as $1, and many even have a feature that rounds up your daily purchases to the nearest dollar and invests the spare change automatically. It's investing without even thinking about it. Another great option is to look for brokerage accounts with no minimum deposit. Many reputable online brokers now allow you to open an account for free and start trading with whatever amount you're comfortable with. This gives you direct access to the stock market. You can buy tiny pieces of big companies, known as fractional shares. So instead of needing hundreds of dollars to buy one share of a popular tech company, you can own a small slice for just $5 or $10. Now that you know where to invest, let's talk about what to invest in. As a beginner, you don't need to become a stock-picking genius. The simplest and often most effective strategy is to invest in index funds or ETFs, which are exchange-traded funds. Think of an index fund as a basket that holds small pieces of hundreds or even thousands of different companies. For example, an S&P 500 index fund holds shares in the 500 largest companies in the U.S. By buying just one share of this fund, you are instantly diversified. This means your risk is spread out. If one company in the basket does poorly, it has a very small impact on your overall investment because the other 499 companies are there to balance it out. ETFs work in a similar way and are traded like stocks, making them super easy to buy and sell through your brokerage account. They are a perfect starting point because they take the guesswork out of picking individual stocks. One of the most powerful forces in investing is something called compound interest. Albert Einstein supposedly called it the eighth wonder of the world, and for good reason. Compounding is basically earning returns on your returns. Here's how it works. You invest your money, and it earns a return. The next year, you earn a return not just on your original investment, but also on the return you earned the year before. It creates a snowball effect. Your small, initial investment starts to grow, and then it grows a little faster, and then even faster. The key ingredient here is time. The longer your money is invested, the more time it has to compound and grow exponentially. This is why it's so important to start as early as possible, no matter how small the amount. A 20-year-old who invests just $25 a week can potentially end up with more money than someone who starts at 40 and invests $100 a week. Time is your single greatest asset as an investor. Let's put this into perspective with a simple example. Imagine you start investing just $50 a month. That's about the cost of a few lunches or a streaming subscription. It might not seem like much, but let's see what happens over time. Assuming an average annual return of around 8%, which is historically achievable with a diversified portfolio, your $50 a month could grow significantly. After 10 years, you would have invested $6,000, but your account could be worth over $9,000. After 20 years, your $12,000 invested could grow to over $29,000. And after 30 years, your $18,000 in contributions could become nearly $75,000. The majority of that final amount is growth from compounding. This shows how consistent, small contributions can build into a substantial sum over the long term. It's not about having a lot of money to start. It's about having the discipline to start and stay consistent. A common mistake beginners make is trying to time the market. This means trying to buy when prices are low and sell when they are high. It sounds great in theory, but in practice, it's nearly impossible to do consistently, even for seasoned professionals. The market is unpredictable in the short term. People who try to time it often end up buying high out of fear of missing out and selling low during a panic. A much better strategy is called dollar cost averaging. This simply means investing a fixed amount of money at regular intervals, like $50 every month, regardless of what the market is doing. When prices are high, your fixed amount buys fewer shares. When prices are low, that same amount buys more shares. Over time, this approach smooths out your average purchase price and removes emotion from your investment decisions. Just set up an automatic transfer and let it run. It's the set it and forget it method, and it's perfect for beginners. As you embark on your investment journey, remember this: investing is a marathon, not a sprint. There will be ups and downs. The market will have good years and bad years. It's completely normal. The key is to remain patient and stay the course. Don't panic and sell everything when the market dips. In fact, market downturns can be great opportunities to buy more shares at a discount. Focus on your long-term goals and resist the urge to check your portfolio every single day. The most successful investors are often the ones who are the most patient. They understand that true wealth is built slowly and steadily over decades, not days or weeks. Trust the process, stay consistent with your contributions, and let the magic of compounding do its work. You are building a foundation for your future self, and that is something to be incredibly proud of. Before we wrap up, a quick but important disclaimer. All the information in this video is for educational and entertainment purposes only. I am not a financial advisor, and this is not financial advice. Investing involves risk, including the potential loss of principal. It's always a good idea to do your own research and consider consulting with a qualified financial professional who can understand your individual situation and help you make the best decisions for your financial goals. So there you have it. You now have the fundamental knowledge to start investing, even with a small amount of money. We've busted the myth that you need to be wealthy, covered the essential first steps, and explored simple, effective strategies for beginners. The most important step is the first one: just getting started. Open that micro-investing account, set up that automatic transfer for $10 a week, and begin your journey. Every dollar you invest is a vote for the future you want to create. Thank you so much for watching. If you found this guide helpful, please give it a thumbs up and subscribe for more content to help you build a better financial future. See you in the next video.